Is Tesla the most overvalued stock in history, or is it a once-in-a-generation opportunity that most people are missing? It seems like everyone has a strong opinion, but today we're cutting through the noise. We're going to ditch the hype, forget the emotions, and do a real data-driven analysis of Tesla's fundamentals versus its story. By the end of this video, you'll have a clear framework to decide for yourself whether Tesla fits into your investment portfolio. We'll break down what's already priced into the stock, where the real risks lie, and where the potential for massive growth could come from. Let's get started. First, let's talk about the elephant in the room, the valuation. When you look at Tesla's price-to-earnings ratio, or PE ratio, it often looks astronomically high compared to traditional automakers like Ford or Toyota. This is the #1 argument critics use. They say, look, it's just a car company, and it's priced like a tech giant on steroids. And honestly, if you only see Tesla as a car company, they're absolutely right. No traditional car manufacturer could ever justify this kind of market capitalization based on car sales alone. So, let's look at the car business first, because it's still the core of their revenue. Tesla's automotive margins have historically been the envy of the industry. For a long time, they were pulling in gross margins well above 25%, while most legacy automakers were struggling to get into the double digits. This was a huge part of the bull thesis. It proved they weren't just selling cars, they were selling high-tech products with incredible pricing power. Third, however, over the last year or so, we've seen those margins compress. Why? Aggressive price cuts around the world. This was a strategic move to drive volume and market share, especially with increasing competition from Chinese EV makers like BYD. The big question for the car business is, are these lower margins the new normal? If they are, it seriously challenges the growth story. The bull case here is that these price cuts are temporary. Once battery costs come down further, and production efficiencies from things like the Gigapress are fully realized, margins could rebound. Plus, there's still growing deliveries at a respectable pace, even in a tough economic climate. The bear case is that competition is here to stay, and the days of 25% plus margins are over. If Tesla's car business simply becomes a normal car business in terms of profitability, then the current stock price is very, very hard to justify. So, what you have to believe is that something else is going on. This brings us to the more than a car company argument. This is where the hype and the potential for huge returns really come into play. Let's break down the three main pillars of this argument: full self-driving, or FSD, artificial intelligence, specifically the Dojo supercomputer, and Tesla energy. Let's start with FSD. This is probably the most polarizing part of the Tesla story. The vision is simple: a future where millions of Tesla cars on the road can be turned into revenue-generating robotaxis, with a software update. If this happens, the upside is almost unimaginable. We're not talking about selling a $50,000 car anymore. We're talking about selling $1 million asset that generates recurring revenue. It would transform Tesla from a manufacturer into a high-margin software and transportation-as-a-service company. The market is pricing in some probability of this happening. The question is, how much? The challenge is that full self-driving is not yet full self-driving. It's an advanced driver assist system. Progress has been slower than many hoped. Regulators are watching closely, and the technical hurdles to achieve true Level 5 autonomy where the car can drive itself anywhere, anytime, with no human oversight are immense. So, investing in Tesla for FSD is a bet on a technological breakthrough. If you believe they will solve it, the current price might look cheap in hindsight. If you think they won't, or that a competitor will get there first, then a huge chunk of Tesla's valuation is built on pure speculation. The recent progress with FSD Beta version 12, which is based on a neural network approach, has reignited a lot of optimism, but it's still a bet on future technology. Next up, AI and the Dojo supercomputer. This is a newer part of the bull case that's gained a lot of traction. Dojo is Tesla's custom-built supercomputer designed to train the neural networks needed for FSD. The idea is that Tesla is collecting an insane amount of real-world driving data from its fleet billions of miles. This data is the fuel for its AI. The bull case suggests that the AI expertise and the hardware they're rebuilding with Dojo could be a business in itself. Think of Amazon Web Services or AWS. Amazon built a massive cloud infrastructure for its own retail business and then realized they could sell that computing power to others, creating a hugely profitable new company within a company. Though bulls believed Tesla could do the same with Dojo, offering AI training as a service. This would put them in direct competition with companies like Nvidia and other cloud providers. The risk here is execution. Building and scaling a cloud computing service is incredibly difficult and capital-intensive. It's a very different business from making cars, so while the potential is there, it's far from a guaranteed success. It adds another layer of high-risk, high-reward speculation to the stock. The third pillar is Tesla Energy. This part of the business often gets overlooked, but it's growing incredibly fast. We're talking about megapacks, which are utility-scale battery storage solutions, and Powerwalls for home energy storage. As the world transitions to renewable energy sources like solar and wind, the need for energy storage is going to explode. Solar panels don't work at night, and wind turbines don't work when it's not windy. Grid-scale batteries solve this intermittency problem. Tesla is a leader in this space, and the margins are already looking very promising. Some analysts believe that in the long run, the energy business could be as big, or even bigger, than the automotive business. The growth rates for megapack deployments have been staggering. The risk here is competition and supply chain. Tesla doesn't have a monopoly on battery technology, and other large players are entering the market. Securing the raw materials for all these batteries, both for cars and for storage, will be a major ongoing challenge. However, unlike FSD, this is a business that is already working, growing, and generating significant profit today. It's a much more tangible part of the growth story. So, let's put it all together. What is priced into Tesla's stock right now? It's clear the market is pricing in more than just the car business. It's pricing in continued dominant growth in electric vehicles, a significant probability of success with full self-driving, and the potential for new massive business lines in AI and energy. The true risk-reward asymmetry appears when you look at these components individually. If you believe FSD is a near certainty, the stock is a bargain. If you think FSD is a fantasy, but the energy business will be bigger than anyone expects, you might still see value. The biggest risk for retail investors is ignoring this complexity. Many people buy the stock based on the hype around Elon Musk or the dream of robotaxis, without understanding the fundamentals of the core automotive business or the very real risks associated with these future bets. On the other hand, many bears dismiss the stock by only looking at the car business and ignoring the very real optionality that the other ventures provide. So, who is Tesla for? It's not for the faint of heart, or for someone looking for a stable, predictable dividend-paying stock. Tesla is a venture capital-style bet in the public markets. It's for an investor with a long-term horizon, a high tolerance for volatility, and who has done their own research and has a strong conviction about at least one of its future growth pillars. You need to believe that Tesla will not just be a car company, but will dominate in at least one of the other fields: autonomous driving, artificial intelligence, or energy storage. If you're a value investor who strictly looks at current earnings and assets, you will likely never be comfortable owning Tesla. If you are a growth investor who is willing to pay a premium for a company with the potential to define the future of multiple industries, then Tesla might make sense for you. The key is to know what you are buying. You aren't just buying a car company. You are buying a portfolio of high-risk, high-reward bets on the future. Thank you so much for watching. I hope this data-driven breakdown helps you think more clearly about Tesla. It's a fascinating, complex company, and understanding these different parts is crucial. If you found this analysis helpful, please hit that like button and subscribe for more deep dives. Let me know your thoughts on Tesla in the comments below. See you in the next one.